Welcome to the Reverse Mortgage video number 1. In this first video, I'm going to answer some of the most common questions. Questions like, what is a reverse mortgage? Why would you want one? And how do you qualify for one? First, let me point out that a reverse mortgage is not a specific loan, but rather it is a category of home loans. In fact, most reverse lenders offer a variety of reverse mortgages, each with unique features. However, the most common and most popular reverse is by far the FHA-insured Home Equity Conversion Mortgage. The acronym is HECM. It's the most popular for two reasons. First, it always has the lowest interest rates. And second, it's insured by the federal government, and banks really like that part. But as I said, there are many private money lenders who offer their own proprietary reverse loans. They usually have more lenient guidelines like lower age restrictions, and they often have higher loan limits. But they always have higher interest rates. What's important is that you're aware of all of your options. With almost every reverse mortgage, you will be paying off your existing home loan. And when you do that, your monthly mortgage payment goes away. We know that traditional mortgage loans are repaid over a period of time, typically in equally monthly payments. A reverse mortgage is not a traditional mortgage loan, and it does not require a mandatory monthly payment. Rather, it is repaid when certain circumstances occur, which we will discuss in video number 3. I emphasize that because it is the single most important benefit of the reverse mortgage, and that is that your monthly payment will go away, but you will continue to own and live in your home as long as it is your primary residence. That has to matter to you. Ask yourself this question: if I didn't have to make a mortgage payment every month, would that make a difference in my life? As I say, the answer should be yes, because if the answer is no, it would not make a difference, then the reverse mortgage may not be for you. But if not having a monthly house payment would make a difference, then let's talk about how you qualify for a reverse mortgage. For purposes of this discussion, we're going to use the FHA HECM loan as our guide. With the FHA HECM loan, the primary homeowner must be at least 62 years of age. If there is more than one person listed on title, not all have to be 62, but at least one must be. That person is considered the primary borrower. Any others who are on title who are not 62 will be considered non-borrowing spouse, and that covers legal domestic partnerships as well. A non-borrowing spouse on title does not have access to the funds available through the reverse mortgage. But don't panic. There is an easy and legal workaround that I'll show you on the next video. And of course, if everyone on title is 62 or older, then none of what I just said applies. Once we get past that age rule, though, there are 4 conditions that must be met to qualify for a HECM loan. Number 1, the property must be your primary residence. Now, for most of us, we only own one home, so it's pretty easy to establish our primary residence. If, however, you own a cabin at the lake or a condo on a golf course down at the desert, they cannot be declared your primary residence unless you live at that property greater than 26 weeks out of the year. And now, again, for most of us, our primary residence is the address that's on our driver's license, it's on our tax return, it's that place we call home. Number 2, you must continue to pay your property taxes. That is a mandatory obligation, and I will tell you that's sometimes where people get in trouble. Number 3, you must continue to pay your homeowner's insurance. Again, that is a mandatory obligation. Now, while these may sound obvious, what we know is that property taxes and homeowner's insurance are often included in our monthly mortgage payment. It's called an escrow or an impound account. If property taxes and homeowner's insurance were part of your monthly mortgage payment and you got a reverse mortgage, then you'll need to set up a new payment process to see that those bills get paid when they come due. And then lastly, you must maintain the property in a livable condition. Now again, this sounds obvious, but if the household becomes dilapidated or uninhabitable, the health department could condemn the building. And if they do that, the loan will become default. You don't want that. Those are the 4 conditions you must conform to qualify for a reverse mortgage. You won't automatically lose your home if you violate any of those conditions, but you will be notified that you're out of compliance and the condition must be corrected. The bank will work with you to help you get back into compliance. Believe me when I say the bank does not want your home. If you've ever heard anyone say, don't get a reverse mortgage because the bank will own your home, I'm telling you that is a complete fallacy. Banks are in the business of managing money. They don't want to own real estate. And the only time that happens is when a homeowner allows the situation to get out of control and it voids the guidelines. So I hope we're clear on that. Did you notice that your income was not included in qualifying? That's because there's no mandatory monthly payment. The bank will, however, look at your credit report. They are looking at the way you handle your debt obligations. If the report shows a lot of late payments or collections or a recent bankruptcy, they may find you to be at risk. Now, that doesn't mean you won't get a reverse mortgage, but they're likely to require a set-aside, which will reduce the amount of money available to you in your discretionary account. So, heads up on that. That, my friends, answers the most common questions on a reverse mortgage. I know this video ran a little longer than expected, but stay with me. In the next video, we're going to look at how much can you qualify for, and what are some of the unique ways you can use those funds. So, refresh your snacks and your beverage, and I'll see you on video number 2.